I would like to welcome my fellow panelists to the stage. You can give them a warm hand right now. So, yeah, financing in the life science ecosystem and valuation, investor sentiment, and market trends. That's what we're here to talk about today. And with me on stage, from the stage right, I have Anthony Leach, Head of Sector Healthcare at Pareto Securities. Welcome. And then we have Olof Åberg, yeah. Healthcare ECM at Carnegie. And last but not least, Dan Bergström, Project Leaders Life Science at Erik Bank. I wouldn't say anything about that, the fact that you are representing the same company today. You weren't yesterday, but that's okay. So perhaps just a short presentation round to tell us a little bit about your specific role in your respective organizations. And it would be great also to hear a little bit about what kind of sweet spot you have in terms of financing companies, transaction sizes, and so on. Could start with you, Anthony.
Yeah, great. So Anthony Leach, Head of Healthcare at Pareto. I've been at Pareto for 9.5 years and had this role for close to 5. My job is sourcing, structuring, and then closing healthcare transactions, basically. Our kind of sweet spot on biotech is, I'd say, phase 2. They have some sort of proof of concept on the efficacy side. Earlier than that, we find it quite tough. On the medtech side, it can be, at a minimum a CE mark, although that's maybe not saying much. But nowadays, we're looking at slightly more mature companies. On the medtech side, some kind of sales is good, and a sort of, some kind of vision of where they're actually going to become sort of cash flow positive.
I thought you were going to say some kind of vision of revenue, but
yeah.
Thank you very much. Olof, what about you?
Yes, so Olof Isaksson Åberg, part of the equity capital markets team at Carnegie, focusing on healthcare. So essentially working as a link between the investment banking healthcare team and the market and all the market participants, as investors, sales, research, and all external parties, essentially. Been with Carnegie for just about 2 years. Previous to that, I was with DNB in a similar role, and then at Pareto even earlier, so former colleague of Anthony. At Carnegie, well, we work basically with the same segment as Pareto does to a large extent within the life science sector. Similarly, we've seen a shift towards mature companies, but we're working both with the private sector and the public companies that are listed already.
Great. You were a colleague with Anthony, and now you're a colleague with Dan.
Yeah, exactly.
So Dan, what about you?
Yes, Dan Bergström, Senior Project Leader at Erik Bank. That was acquired by Carnegie yesterday, and it will be great joining. But we have a different focus. We are more smaller companies, so our target niche is the First North segment. And we work in a pretty fast-paced organization, flat, so we work with the whole project management and also with securing the transaction. So everything from working in the projects and the securing the capital.
Thank you very much. So securing the transactions and bringing in capital is a key component of what all of you do, and in that then that involves tight dialogue with investors. So how would you say that investors, given the challenging market conditions, how have they adjusted to all these new realities that we face today, would you say? You can start with you, Dan.
Yeah, basically we can see that they have started looking a little bit more inwards. They are looking at what eggs do they already have in their baskets, what do they need to protect those eggs. Is there any eggs that they should specifically focus on, or maybe some that they can't focus on? Is there room to add more eggs in the basket? It's the big question for them right now. And also we see that they limit the risk that they are taking. They are decreasing somewhat the size they are taking in new bets. So we see that they have adjusted in those ways.
Is that something you have seen along your investor base as well?
Yeah, I very much agree with that summary. And I mean, it feels like the key theme with investors now is just an increasing risk aversion that they're looking at. I mean, where do we have risk of, I mean, downturns in our portfolios? And another focus is really the liquidity, both, I mean, liquidity in the stocks, but also liquidity in their own portfolios, as we're coming from a period of significant inflows to essentially all public funds. Now that capital is partly flowing back out of them, so they need to manage both the cash that they have at hand to support the companies that they already own, but also look at, okay, which companies have a liquid trading and which do not, and then try to manage risk in that regard.
So risk management and also protecting what you already have, a general theme. Anthony, would you say, we talked about earlier with another panel here about also this market being perhaps then, giving birth to some opportunities. Do you see any of that sentiment within your investor base?
Well, I mean, I'd say the investor base is, adjusted, as you said, and that's basically by allocating less money to life science. I mean, I think it's halved over the last few years, the percentage of AUM allocated to healthcare, or medtech and biotech specifically. So that's their adjustment, and we're trying to adjust accordingly and finding new structures. There's certain types of debt instruments that work for some companies, but in the end, it's tough. I mean, it's for the investors that want to take risks now. As long as they're doing a good job at picking their companies, they're going to be getting stuff at a sort of bargain price compared to what they were doing a few years ago. And if you look at the specialist money that's flowed in, I mean, first half year to date, I think that they were on par in fundraising as they were maybe all of last year, and also pre-pandemic levels. So the smart money is building up the sort of coffers, and they're going to take advantages of this, and then I guess maybe the generalists come back for the next bubble.
Speaking of bubbles, then IPO activity, we've seen record levels in the past few years, and now that IPO window is firmly shut, you could argue. And how does that affect the investor view on the life science sector? You think the fact that IPO as a possible exit is virtually non-existent right now, is that something you have reflected on, Don?
Yeah, we can basically see that when we are talking with investors, there are a number of them that are saying that they are having positions in several companies that were supposed to be in an IPO. So they see maybe limited opportunities right now to add an extra company to that pipeline. So they are structuring their portfolios, and I think we would need to see some more IPOs for some investors to start building up their positions in that segment again.
Mm. And is that the signs of any such activity sort of reigniting and coming back to life? Do you think that, are there any signs pointing to that direction? What would you say, Olof, about that?
I mean, I think when we got back after the summer holidays, I think we were increasingly optimistic that we would see some increased activity in H2. And then markets, unfortunately, developed in a way throughout September that almost put a complete stop to those ambitions. There's been some companies in both in Sweden and the Nordics and in Europe that have tried to come to market, but it's been with quite mixed results. We had Usta this last week that has been trading just above issue price, so that's a positive sign. But if we're looking at a broader perspective, I mean, many of the IPOs that we've seen in Europe have been pulled over the last few weeks just ahead of intended first day of trading. So it's looking at IPOs as a product. We're still lacking the confidence from investors that it will work out the way it's intended to do.
And Anthony, is that a view that you share in general?
Yeah, I mean, the IPO market is not dead, it's just in a coma. So we're going to have to wait a little bit, and I mean, things turn around, and they turn around usually faster than anybody expects them to. I mean, was it beginning of 2020 when we had COVID, everybody thought, okay, game over. then just before the summer, everything sort of ripped up again. So I think the same will happen this time, but I think this might take a little bit longer.
I think just to add to that, I mean, I think the key thing with IPOs is that you have to have the market fundamentals, and those have been improving somewhat, but then you also have to have the confidence in IPOs as a product, because that's essentially IPOs is an attractive way, or intended to be an attractive way for investors to add alpha to their portfolios, essentially a way to beat the market in that regard. And if the general sentiment and consensus is that IPOs won't trade well, then it will be difficult to get them done, because then the product isn't working. So that's really what we need to see.
And also in a difficult market, it is possible to do IPOs even if the market is difficult, if you have the right type of companies. Like last year, it was also a rough market. We did an IPO after the invasion of Ukraine. Promimic, a nice life science company with nano coating of implants, and that was possible to do with strong support from current shareholders and an attractive niche. So it is possible to do IPOs, but it is tough.
And I think that's the key. I mean, strong support from current shareholders. I mean, for an IPO to be successful in Sweden, you have to have the Swedish institutions behind you, and if they'll get comfort from a sort of current strong shareholder base. I mean, nobody can rely on just getting the foreign money to make an IPO happen. So,
needing to have then investor confidence in, like you said, IPO as a product, as a attractive offer then. And speaking of it being in a coma right now, I mean, if you have a patient in coma, you would be staring at the EKG screen, hoping for a little blip somewhere. Maybe not EKG, maybe it's EEG, I don't know. You tell me. Anyway, you'll be looking for that little blip that's a sign of life, basically. And so if we don't have that now, what should investors in general be looking for? What kind of signs in the market should we look at? Is it enough if the interest rate goes down, for example?
I mean, at the moment we're in an environment that there's still quite few directed issues happening for taking in new money. Most of it is, I guess, still rights issues. When that starts to go back to more sort of directed issues, private placements, then that shows that market is functioning, and then the IPOs will probably follow after that.
And what will make that market function? I mean, is it investors seeing that they will make some kind of return fairly easily? Or?
I mean, I think it's up to the companies to show some pretty fantastic data.
You were going to add something, Olof?
Yeah, I mean, just on the what signs are we looking for? I mean, it's the important thing to remember with IPOs is that it's one reason why it's such a high risk offering type is that, I mean, the market exposure you have extends for almost a month from intention to float to first day of trading, and then you ideally want to launch the IPO in a calm market. So one very vital factor for investors and companies to look at is the expected volatility in the market, and that's something that we're monitoring closely. And that's, I mean, the magical level in a historical perspective has been that should be below 20, and now we've actually seen it below 20 for much of H2. Now it's a bit above again, but it's at least a positive sign that it's starting to trend below.
Yeah, stability is really the key, because if you have stability, then you can actually count on things, and if you can count on things, then you can make a good business decision. So I believe that stability in some sort is a key factor.
More calculated, easily calculated risk then. So IPO is one thing, but we already have quite a few listed companies, especially in life science in Sweden and on the Swedish markets. And well, it's safe to say that quite a few of them will need to raise capital within the next 12 to 18 months, some even sooner, from a pretty acute state of mind, so to speak. What can we expect? There are so many companies that need funding, and if the investor sentiment is very cool, what can we expect then to happen, you think? Do you think, Don?
Well, in the case of raising capital right now, it's a key factor as well as in the IPO that we mentioned, that you need to have the support of your current shareholders. Because what we see is that if you have some lead investors to follow, then you're actually you're getting more traction with the other investors that you need to secure the full funding. Because in many cases you need to reach a minimum amount of funding in this typical sector in case to fund a study, you need to fully fund it. So make sure to be involve your current shareholders, have them informed of your progress, and don't just approach them when it's time to beg for more money. So keep them involved and informed.
That sounds like good advice, and we're all here to help with that. Well, if you're going to add something.
Yeah, no, I was just about to say that is, I mean, also what to expect is that it's going to be actually probably a lot of quite painful capital raisings, and it's just the reality of it. So it's best to try to plan for all scenarios from the get-go. I mean, even if you're targeting a directed issue to begin with, there's no harm in having a plan B or plan C, which is other financing alternatives, and know when to switch from plan A to plan B to plan C.
And we've also earlier touched upon that with the alternative financing alternatives. Can you give any examples of what you have been seeing lately in that respect?
I think it's very much in line with what was mentioned on the previous panel discussion, that we're seeing, for example, we're seeing an increasing share of rights issues, and in the rights issues we're seeing more and more transactions that are being structured with a combined share and warrant element, just to both to make it more attractive for investors, but also to build in the flexibility that we're giving you some money now, and then when you're proving yourself, we can exercise the warrants and continue to fund you at that stage. And then also, I mean, we discussed convertibles were discussed earlier, and that's also something that we see more and more, and even some companies that are looking more into private credit funds for an alternative source of capital.
And then seeing as like you said, you need the support of your existing shareholder base, and you could also, like I think we touched upon that also, with more tranched transactions, or picking capital in tranches, basically, with warrants. But then could that not be also sort of a downward spiral, that you make a rights issue and you include warrants, and then you really have the knife to
It depends where you're striking the warrants. I mean, if you do a rights issue and attach warrants to them, you can either strike the warrants out at the same price as the rights issue, which is already a massive discount anyway. Then you don't get the downward spiral, right? Because there you have your floor. But if you're doing a sort of 30% discount to some price in the future, then there's no. I mean, why is anybody going to hold on to the share? They know they're going to be able to buy it a lot cheaper later on.
So there are a lot of moving parts, and that's why companies should talk to experts when they raise money. So I got my papers in order here, and yeah, we touched about are there any positive signs, but what are the expectations then from the companies getting out there now raising capital? What are the expectations on valuations, and how does those expectations align with investors' view on valuations, would you say?
Well, actually, now after the summer, we feel that the companies that are at least the listed companies, they have come to a much closer approach to where the investors have been doing, where they feel that the valuations are. So we actually see a little bit easier on agreeing on the valuation of the companies right now. So in the listed market, we see that, but that is also because you have a market price that is adjusting every day. And so in the First North segment, we actually see that it's a little bit easier to meet investors and companies at the moment.
And if you are doing transactions in the higher transaction size level, is that also true? Is it easier now to see a good balance there between expectations from companies and investors alike?
I mean, well, in the listed company, it's quite easy. They have a share price, so that's where the fair value is at the moment. That's where investors are pricing it.
Hard to argue with.
Yeah, but I mean, it's simple. I don't usually get into too many sort of valuation discussions with companies. I basically tell them that this is how it's going to work, and this is the pricing, and you know.
But wouldn't the discussions then rather be about discounts rather than the actual valuation?
Yeah, I mean, the discount is particularly on rights issues, whether it's a 35% discount to your TERP or it's a 40% discount. But the balances shift over to the underwriters of the transactions, right? So they're the ones that have the money. They're the ones that can underwrite the deals. They're asking for bigger discounts. But you know, realistic, you're looking somewhere like 40% discount to TERP nowadays. Underwriting fees, double digit, where they would probably be maybe 7-8% in the good old days. But it's just, you have to be realistic with the companies you're working with.
Yeah. Do you want to add something?
Yeah, no, I was just about to add a bit on the kind of the private market perspective, and I think those discussions are also easier today than they were a year or a year and a half ago. It's easy to think that if you're a private company, you're somewhat protected from the moves in the public market, but many investors invest across both public and private asset classes, so they will of course mark their valuations towards what's happening in the public market, and feels like more people are aware of that today than they may perhaps were a year and a half ago.
And now, I mean, in biotech, you see the sort of more traditional private market guys, they've actually started to look at public markets as well and taking that into their funds. And that's, I guess, mostly because prices have come down a lot faster there than they did in the private markets.
So they see the opportunity there. Yeah. So, but Anthony, you were touching upon the fact that underwriter fees are higher now, and well, basically cost of capital, raising capital, and that's also true, I think, for guarantors, using guarantors. Is using guarantors in a market like this, is it even? Should you do it or should you not do it? What do you say? I
mean, usually when a company comes to me, they actually need the money. It's not just a nice to have, it's a need to have. So if there's 100 million that they need, then then you're not going to get any investors in if the money's not secured. If it costs 100 million to do the project, that's the minimum amount that you need to get in. And then you have to adjust the structure accordingly to make sure that they have the money to get to the next milestone. Otherwise, everybody's kind of wasting their time. Mm.
Is that your reflection as well, that you just do what you have to do, basically?
Yeah, I mean, especially in this sector, when it's so clear that the money you're raising is expected to take you to this and that milestone or finance this and that study, then it becomes pretty crystal clear that this is the amount you need, and then it's not a question of how much do we want to push sales, for example, because then you can adjust based on how much you raise. But when it's a fixed amount, it's a fixed amount. So then the guarantors, you should think about them as an insurance, basically. And now the prices of that insurance has increased.
Yes, and you were also mentioning the fact that you need the support of your existing shareholder base. But if you can't muster that support, then you're really in the hands of guarantors, for example. Is that correct?
Yeah, that's correct. And in the case of securing those deals, it's as we heard from my colleagues here, that you actually need to fund the specific amount that is needed to conduct the studies and so on. And then it's often, the last krona that comes in, that is the most important krona, and it will reflect on the price to secure the transaction. And as Anthony said here, we see double digits for sure. Seen it for the last couple of years. It's around in the smaller niche segments. It's around 12%, I would say. I think we have gone up to 14, the highest, but we also see transactions that are up to 15, 20%.
And I think these comments and this discussion around the importance of shareholders just kind of reinforces what Peter said in the earlier panel discussion about how important it is to already at an early stage think about what kind of investors you get in and not only how much are they investing and at what valuation, and try to really because now in these times it becomes crystal clear that it makes all the difference in the world who are funding you.
So would you say that the market climate, investment willingness, if you will, and all the signs that are now pointing towards continued, perhaps a little tough time. What do you, in general, expect for the Swedish life science market? Say in 3 years' time, do you think it's gonna become like a quick turnaround at some point when things start to lighten up, or do you think it's going to be a long slowly downward spiral towards something bad? What do you think, Don?
Well, how long these market circumstances is going to last, it's very hard to answer, but it can definitely become worse as it is. It's the geopolitical situation is it's very disturbing at the moment, and it might be it might be a long period, it might be a shorter period, but it can get a little bit worse. But at the same time, we see that there's a lot of companies that their valuations had come down very much. So we see that there is already some investors that are seeing that, okay, I might be in the negative returns in the short term, but this is an attractive level long term. So in 3 years, then I would say that we definitely have bounced up from here.
You share that view?
Yeah, I do, and I was just about to say that. I mean, given that interest rates have been the key theme over the last 2 years, and really what's been driving markets to a large extent, I think that as soon as we're seeing interest rates kind of leveling out, and we know that we have seen the peak or past the peak, then we will start to see improvements. But then we won't go to zero interest rates in a week, but that will be a gradual process. So hopefully the turn isn't too far away, and then we will start to see a gradual increase as we go along.
You share that view?
Yeah, more or less. I mean, I don't think things are going to turn around super quickly. I hope in 3 years' time we're back to some kind of normality. Otherwise, things will be pretty depressing. But I think the companies that are waiting for better times before they pull the trigger and sort out their financing, they're just going to get into an even worse position.
That could be could be a scary chicken race, so to speak. Well, given things are what they are right now, and that the outlook is what it is, what would be your respective key advice then to companies that are in the situation that they need to get capital within the next 12 months, for example? I see that we have about 2 minutes left, so if you use 40 seconds each, that should do the trick. What about you, Don?
Okay. Number one advice would be not wait too long until you contact a financial advisor, because the runway to actually get the financing secured, it's much longer than it was 2 years ago. So there is much more work needed to be done now to secure the funding necessary. So be sure to be out in good time, because it's also reflected. The investors can see your balance sheet, and the sooner you're out and make sure it looks all right before it gets really bad, the better.
And as you follow Dan's recommendation to engage the advisor early, I mean, dare to have the kind of the difficult conversation early on as well. I mean, what do we do if the intended plan fails, and when do we need to switch over to plan B?
Echo and all that. Also spend a lot of time looking at your projects and make sure you have a plan to fund the stuff that is a need to have, that's going to sort of get you to your milestones quickly, and have good news flow, and the nice to have projects don't matter any longer.
So contact a financial advisor sooner rather than later. That's going to be possible in a little while when we have the next break, I guess. You can meet them out here. I'd like to thank you very much for taking the time and for sharing your insights today. Thank you.
Thank you.
Thank you very much.
Well, thank you so much for that very interesting discussion. Now continuing with our company presentations, I'd like to welcome up to the stage Peter Eckelund, CEO of Combigene. Welcome, Peter.
Thank you very much, Mike. I would like to address a question to the audience, the first I do. And how many of you in this room know someone in your close relations who has been giving a gene therapy? Hands up. Well, 0. I'm not surprised because gene therapy is still very exclusive. But in if I ask the same question 5 years from now, I'm sure that I will see more hand raised. My name is Peter Eckelund, and I'm started as a CEO for Combigene in about the 1st of September, actually, so it's quite new. We have a vision, as you can see, and we also have a disclaimer. We are listed on the First North. Gene therapy, well, it's new possibilities. Sorry. And in Combigene, we have 4 projects, one in epilepsy and one in lipodystrophy. It's a very rare disease. And then we have a quite new pain program with 2 different options. I will come back to that later on. But gene therapy gives... Combigene has a solid knowledge in drug discovery and gene therapy. But even though we know that not all of the projects that we are working with in drug discovery will come to clinical studies or even reaching the market, we need to look for more assets, more projects. And that's what we are constantly doing in Combigene. This is what I was talking about, sorry. I will also show you our business model. It's quite straightforward with a in-licensing phase. We are looking for assets from researchers, academia, or from companies. And our lipodystrophy project is coming from Lippigon, and the pain project is from the Danish company Cernero. When we have in-licensed the assets, we start working with the development phase. And here is our core competence. We have lots of good project leaders who are very skilled in drug development. And what we are putting together is a kind of proof of concept for the preclinical package. And when we have that, we start to approach big pharma and try to out-license the object or project to them. And when it's from here we have the revenue stream coming in in down payments and different milestones. And it's here that we create value for our share owners. Second question, I guess I will have more hands in the air. I was asking, because I'm moving over to our pain project, how many in the audience know someone who have chronic pains? Hands up. Yes, I suppose so. Because that's meaning that this audience reflects what we can see in the society, that approximately 1/5 of the adult population suffering from chronic pain. And that's cost the society a lot of money, as you can imagine. If we look at the chronic pain from a patient perspective, there is a lot of symptoms associated with the pain, and that at the end leads to a significant reduced quality of life. You can't work, you can't be socialized with friends, and you constantly have your pain breaking your physiology. But what does it mean from a societal perspective? If you take this 1/5 that have chronic pain and go down and see who have severe chronic pain, you will notice that still it's not 20-25%, but still it's 7 to 8% who's suffering from severe chronic pain. That means that you probably can't work anymore, and that drives a huge amount of cost for a society. And in this estimation in the US, you can see that the pain is calculated to be around $635 million per year. That's more than what cardiovascular cancer and diabetes cost the society. So it's huge costs. And today's pharmaceuticals are insufficient. They are not designed to help patients with chronic pain. It's a general painkillers, but it doesn't help the specific the mechanism behind chronic pain. So there is a need for a new approach to chronic pain. And in this program, COSI, which is the collaboration we have with Scandinavia in Denmark, the researchers there have found out that in a normal pain signaling, this is a neuron. You can see that the pain signal is going through the green receptors here, and that's fine. You should feel pain. But those patients who have a chronic pain, they have extra receptors, the red ones here, making the signal much more amplified. So even a light stimuli, a light touch, can end up in a severe pain signaling for the patients. And if you're then giving traditional painkillers, it will be like a filter. It filters away lots of the signaling, but it doesn't give complete pain relief. And you also makes lots of other problems while you're filtering the signaling. The solution here with the COSI program is that we are giving the patient a PIK1 inhibitor, because the PIK1 is the reason for putting more receptors on the surface. And when we're blocking that, we will restore the normal pain signaling in the neurons. The pain program COSI consists of 2 treatment modalities, but it's the same mechanism of action in these 2 different compounds. One is the COSI-01. It's a peptide, and the peptide you can give like a subcutaneous injection, like insulin, and get pain reduction. But if you have a chronic severe pain where you don't think that you will get rid of the pain, then you can use the second one, the COSI-02, which is a gene therapy targeting this patient's pain condition. And in fact, the gene therapy makes the cells to produce the peptide. So we have the same mode of action, and you can also use the peptide to test and try and see if the patient are responding on that before you give this more expensive gene therapy treatment. The researchers in Copenhagen, where this come from, they have tested this in several pain models. So we know it works in different kind of pain models like this. But we also know that we have a persistent effect for over a year after one dose of the gene therapy, the CO2. So to finalize this, I would say that gene therapy is on the rise. We will see more of gene therapy in the future. The COSI program is a new way of treating chronic pain, and there is a significant need for that. So badly that the NIH in US have funded a special program called Preclinical Screening Platform for Pain, just to find out what kind of new substances can we use without addiction. And COSI is in that program for evaluation. And in Combigene, we have a strong ambition to license additional gene therapy assets, as I mentioned. We are a strong team with a track record of out-license to big pharma. So thank you very much for listening.
Thank you, Peter. Well, you started off by saying you asked people to raise their hands if they knew anybody using gene therapy, and nobody raised their hands. Why did nobody raise their hands?
Because still it's a very exclusive therapy. And it will be an exclusive therapy as well in the future, I guess, even though I think that the manufacturing cost will go down and there will be more you will have more specific gene therapies, so we can have smaller doses and so on. But there is lots of novel gene therapies coming out to the market.
Maybe you can tell us a little bit about why gene therapy is so promising?
Well, I think what you can do with gene therapy is that you can replace a malfunctioning gene, or if it's lacking, and you can have those function back in the patient. But you can also, as you saw with the CO2, you can actually build in a pharmaceutical industry in your body, the producing the kind of peptides or whatever you want or need.
So a lot of potential in that sense, for sure. Just looking at some questions that I'm getting here, you talked right at the end about wanting to in-license projects. And when looking at in-licensing, what are you mainly looking for exactly?
We are looking for early projects, and preferably where we have core competences, and that's it in CNS and metabolic diseases. But we are quite flexible. If we find something that are interesting, we look into that, of course.
And another question I have here, what's the expected uptake of gene therapy for pain patients? It's a double, there are actually two questions in one here, so I'll let you answer that. What's the expected uptake of gene therapy for pain patients?
For the gene therapy, you say? Yeah. I think you have to notice that some patients have chronic, severe pain situation. And they, like if you have an amputation and you have phantom pains, there will be very little success for that to vanish. That could be a typical patient that could benefit from a gene therapy.
Okay. And the second part of the question is, which percentage of patients do you expect to be ready to embark on a gene therapy product? It's very
that's a difficult question. I can't tell you right now.
Fair enough. How do you plan to attract future partners, and what is your strategy for building successful partnerships?
I think we evaluate a lot of assets, and I think what we are being better and better off is that we put in the commercial aspects of the assets, like more interesting than the scientific part of it. So gene therapy normally address small and narrow patient groups, but I think there is a swift to larger patient groups in the future.
Well, great. Well, thank you so much for answering the questions, and thank you for your presentation, Peter.
Thank you.
Next up, I'm happy to welcome Erik Sundqvist, CEO of Peptonic Medical. Hi, Erik.
Hi there. Thank you very much for the opportunity to present Peptonic Medical here today. Peptonic Medical is a Swedish femtech startup company on a mission to revolutionize intimate healthcare. And if you look at the intimate care category, it's basically anything within reproductive and sexual health. The part of this where we are focusing is medical conditions that can occur in this part of the body. It's already today a very sizable market with 300 billion SEK on a consumer level worldwide. 25% is still a shameful area, and 25% never seek help. Annual growth rate, depending on medical conditions, is around 3 to 12%, where we see a faster growth for self-care solutions. We want to liberate and empower women, and we want to do it in a safe and joyful manner without shame, as our country manager Fanny says for Sweden. And we do this by building a portfolio where we diagnose, we treat, and we prevent intimate healthcare issues. If you look at some social trends, this is from a big survey done during the pandemic, where 65% said after the pandemic, I will take better care of myself, of my health. 80% said I will do that with self-care solutions because I want to take pressure off healthcare systems. If it's not very severe, I want to handle the self-care. I want to handle my health myself. But if I do that, I want to do it with clinically proven self-care, proven products. Based on these observations, we have positioned our portfolio that we are building. On the left-hand side, there are products within self-care without clinical evidence. On the far right, there are, of course, prescription products. About 1/3 is self-care, or this 300 billion kroner market. And we have positioned and working very hard to position in between non-proven self-care and prescription products a clinically proven self-care portfolio. That is VeggieVital, our brand. And I mentioned there are a number of medical conditions that can occur. That's vaginal atrophy, vaginal candida, bacterial vaginosis, urinary tract infections, a number of them that can occur during different stages of life. And for example, vaginal atrophy, which means your mucosa is dried out and thinned. It causes a lot of pain. 50% of all women after menopause. 30% of all women that are still fertile have a problem with the imbalanced microbiota in the intimate area. And then you have about 9% of all women have a urinary tract infection. So depending on age, depending on type of problem, we have various prevalences, but it's a very big area with hundreds of millions of women affected. Looking at our portfolio, what we are building, as we mentioned, a most complete offer. We diagnose, we treat, we prevent. We do it with clinically proven products. And we have a strong pipeline. Only 2 years ago, we had 2 products. Next year, we will have more than 15. And as far as we ever can, we do patent our products. So we have 11 patent families currently. I will just briefly take you through the products we have. Currently, we are launching end of this year a self-diagnosis for urinary tract infection. A self-diagnosis in the middle is our biggest seller for self-diagnosis for bacterial vaginosis. And this is our biggest seller worldwide. We sell it through, we just mentioned to the market, we sell it through Walmart, Walgreens, CVS in US, and we sell it through Bayer Healthcare in Europe. And then we are launching next year, early next year, a menopause test. And a 4th product in the test range is in the latter part of pregnancies. 20 to 30% of all pregnant women visiting the gynecologist have a problem with leakage. that is not identified, and it can be urine, then it's not a problem, or it can be amniotic leakage, fostervatten in Swedish, and it's not that it's released, it's just dripping. And if that happens over time, you can have problems with the orphan, and you can have problems for the mother. So you need to get it diagnosed, and we have a patented solution with 97% accuracy to diagnose amniotic leakage. Then we have our treatments. We have a hormone-free treatment for vaginal atrophy. In the middle, I mentioned our biggest seller is the self-test for bacterial vaginosis. We're just merging with another Swedish company called Pharmiva. They have a patented treatment here for bacterial vaginosis. So we diagnose, we treat. We're building this portfolio. And then next year we will launch a product for vestibulitis, which is a big problem for younger women, about 10% of all younger women with extreme pain. So we have a patented solution we're bringing to the market for vestibulitis. Prevent, we're also building that range. When you have it diagnosed, what is your problem? When you have treated it, getting rid of it, how do you prevent it from coming back? So we have a patented intimate wash that is more than a wash. It also strengthens the intimate area and moisturizes it. And then we have preventive gel for urinary tract infections to prevent them from coming back. The last I want to mention is, we said this is still, even if it's a lot of improvement, is still connected with some shame. So how we communicate this is important, and we also work very closely with healthcare practitioners, and we work a lot of women seek information. We work very actively with information, how to find the treatments and solution for this. And we are not the biggest company yet, but we hope to grow and become sizable, so we have to be small but smart in our way of working with this. We are quite explicit. We mix beauty with care and some humor based on this. We had a very successful campaign in Sweden this summer, which also led to all-time high in Q3. Being very explicit in our marketing, we also need to base that on a very serious platform, which we do. To be a medical device company, we have already spent 12 million euro in research and development. So we do a very serious platform. When you're explicit, we think is important. We started off with one product for 50 plus, and then we started with a product for younger women that is very expensive. So we are building a portfolio that's a value for women, but it's also value for our marketing money, that we have a portfolio for each age group, because you can have different problems during different times of your age. And we just released our Q3 report, and we did tell the market our home market is growing really fast. That's where we are creating a reference model. That's where we're creating a toolbox, where we'll then now, when we are going for more rapid geographical expansion, we'll use that model to support our partners to grow their local business. We're currently in head office in Stockholm in Sweden. We have a sales office in US, and we acquired 2 years ago these self-tests from an Israeli company, so we have development and production in Israel. I should mention that it's a horrible situation in Israel, but our plant is in an unaffected area, so we'd still produce and deliver. We sell about 30% of our sales in our home markets, our reference markets, Sweden. Our biggest individual market with the channels I mentioned is US, and then we sell about 30% of our business to partners in Europe. We also have a wholly owned subsidiary in Finland called Lund, and they are a market leader on sustainable period products under the brand name Lunette. That's a very competitive area, so what we're doing now, we are focusing that on fewer markets and improving the result. And what you can see, if you follow our development, is that we are improving the result and we are growing rapidly. And underlying is our core business, diagnose, treat, prevent for medical consumer, is growing very fast. And when we move into 2024, we have the portfolio now, we have the reference market in Sweden, and we want to bring this portfolio and toolbox to our partners and sign more. So why invest in Peptonic? It's a fast-growing market, gaining in attention. We have the most complete offer. We diagnose, we treat, we prevent. We have a scalable business model. We set the reference market in Sweden, and now in partnership with local distributors, we will help them grow the local business. And we have a strong team. Up till very recently, there were very few of us. We have strengthened the team now with a partner manager, a new CFO, and with the merger with Farmiva, we will strengthen the team even more. So we are also getting ready on an organizational point of view to start to grow this faster from 2024. So with that, we hope we have raised some interest for joining Peptonic on the journey. That would be fantastic.
Thank you so much, Erik.
Thank you.
Well, I'll start right away with some of the questions I'm getting here in the chat. There are quite a few. How do you work to break the stigma around vaginal diseases? Can you give concrete examples?
Yeah, I think we showed some. We tried to base it on making the whole marketing aspect of it appealing, beautiful, nice, caring, with a sense of humor. So we do think we break the stigmas that way.
Mm-hmm. And how big of a role do cultural conditions play in your marketing strategies? Do you adapt your marketing depending on the cultural context?
Yes, I mean, for now, our biggest market where we are marketing ourselves is Nordic, is Sweden. So, but I lived, for example, for 10 years in Hong Kong, work in the Asia region. There you have to adopt the strategies. So we will see now when we focus more on geographical expansion, how we adopt. But I would say the base is always the same, and then you top it up with the local adoptions.
Mm-hmm. Speaking of geographical expansion, do you see more interest in certain areas of the world?
We see interest all over the world. I think the whole world is growing their interest and attention to this marketplace. Where we see the biggest growth is US, now with the channels we have, and then we're focusing on signing partners in Europe. So our focus is US and Europe, and later on my old area, Asia.
Mm-hmm. Yeah, you talked about the merger between you and Farmiva,
yes.
For example. What are the benefits of this merger?
I think one key benefit, as I said several times, we want to build a diagnose, treat, prevent, and our biggest seller is this self-test for bacterial vaginosis, and the Farmiva company has developed a patented unique method. So we think that will be lovely addition, diagnose, treat. And then, of course, as I said, we have been a bit thin, especially in the headquarters. We will become a stronger organization.
And that's actually a question I have here. How will the organizational structure change as a result of the merger?
We will get some more, we haven't communicated this yet, but we will have more commercial capacity, but also more on the regulatory and development side.
Mm-hmm. And someone is asking, they're curious about whether will you continue buying companies?
Oh, that's a very relevant question. The way we have built the portfolio so far is a combination of own development, acquisitions, and mergers. We acquired the Israeli company 2 years ago. Now we're merging with Farmiva, and to complete the portfolio, it might be more acquisitions, but we're getting close to have a complete offer. So let's see.
And what are your principles around sustainability?
I mean, if you look at the wholly owned subsidiary in Lund, the whole objective with that is offer sustainable period products like menstrual cups, period panties. Mm-hmm. We also have on some of our products, we have, instead of one-off applicators, we have reusable applicators. So we do what we can to contribute to sustainability.
And just the last question, what can we expect from Peptonic in 2024?
You can expect an accelerated growth. You can expect that we are launching another 10 products, and now we've gotten from 2 years ago to more than 50 next year, and we are rolling out this concept now with diagnose, treat, prevent, including a stronger organization with the Farmiva merger.
Mm-hmm. Well, looking forward to following Peptonic then. Thank you so much for your presentation.
Thanks a lot. Thank you.